Hey, this is Aman and I'm a financial analyst. In this video, I'm going to explain what is DCF valuation through this Newgen Software Technologies DCF valuation. So let's get started. So before going into the numbers or the research part of the DCF valuation, we have to understand these things. So the most important things in DCF. The first one is revenue growth. So your revenue growth is the like one of the most critical part in your DCF valuation. It has to be realistic. Okay. Most of the time people just do the average of the past 5 years. People just take some other things. So your revenue growth should be according to the future. So you have to find the uh, correct way to forecast your revenue growth. So how you can forecast your revenue growth? So for that you have to read the con calls of the company. You have to see the industry, how the industry is growing. You have to check the annual report of the company, and you might have to read some research reports to understand what the perception of the analyst about the company. So you have to research enough uh, to forecast the revenue growth of your company. Same goes with the EBITDA margin or EBIT margin. These both of these things is the fundamental of the your valuation. So you have to get these things right. You should be conservative a bit while assuming the growth rates of your business or the margins of the business, because it's a technology company, and technology changes really fast. So you have to be conservative in although in every valuation, because you don't know how the future will unfold. So that's why you have to be a little bit conservative while assuming or while forecasting your growth and margin. Okay, and the third part is the reinvestments. So reinvestments consist of your capex, the capital expenditure that you'll do, and your net working capital that you will use in this business. So capex, for this business, this is a IT company, so your capex would be bit less for this company, because it's the IT company. You don't have to purchase a lot of land, or you don't have to put a lot of cash into machinery or plant. It's a IT company, so the capex would be a bit lower, and your net working capital might be a bit higher in this model. Okay, and reinvestments and your revenue growth should be connected, because if you want to grow exponentially, if you want to grow, let's say 30-40% for next 2 to 3 years, so then you have to put the money for the growth. Okay, the growth comes from the investments. You have to invest in your business to get that growth. If your revenue growth is lower, then your reinvestment would be probably lower. If revenue growth is higher, then you have to put good amount in the reinvestments also. So most of the time what people do is like they take capex as the percentage of revenue. That's fine. It could be it's fine. Okay, and the fourth part is the WACC, which stands for the weighted average cost of capital. It's a discount rate, so we'll see how to calculate that. And the fifth one is terminal growth rate or perpetual growth rate in this. So what happens is, if you are projecting free cash flow, if you, let's say you have 1 year free cash flow, you have 5 years, and then 10, it's your last year in your model. So what happens after 10th year? Would the business shut down? No, business will go on after that period. So to incorporate that thing, that the business will be continuing after that period, we have to calculate the terminal value of the business. So for that terminal value, we have to have the growth rate in which after the 10th year of the business would grow at a perpetual growth rate. So these five things are the most important things in the DCF valuation. So this is the overview, like what we have to find to make our financial model, and to analyze or to come up with a good estimation. You have to read lots of things. For example, you first have to screen the stock. You can get an overview of the stocks through screeners, through Yahoo Finance, through other platforms, screening platforms. So this is the company market cap as of 22nd of March is around 14,000 crore. Current price is 1000 and 1034, and high and low is around 1800 and 620. The PE of the stock is 50, and if we see the ROCE is 26.6, and PEG ratio is 2.54, and industry P is 30. So if you just see that the company is a little bit overvalue according to the industrial PE. Okay, although it's not refined data, so we don't like we cannot rely on this data. We just getting some overview of the company. You can see here it's you can see the revenue stream of the company. It's a annuity based revenue. For example, company has the recurring software fees on annual basis, or okay, it's a subscription fee that company get, and some annual maintenance charges. Okay, and the third one is support. It's a like annuity-based revenue consists of set subscription and annual maintenance charges and some support charges that company charges to its customer. Third one is sale of a software product. So it's a one-time. For example, if Newgen is selling some software to, let's say, ABC company, then they'll record some one-time software product uh, in their books, and after that they'll charge them a subscription or AMC charges or support charges on annual basis, or other thing. Okay, so this is the one-time charges, and third one is sale of services. They uh, for example, they like implementation and the development part that they do, and they develop the software, this developed some management systems for the companies. So it's the third part of the revenue. So these are three parts: annuity based, and sale of the software, and sale of the services. Okay, the three parts we have for the and most of the parts of the revenue mix comes from the banking and insurance sector of the company. So we'll see in the annual report that 70% of the company revenue comes from the banking segment. For example, yeah, we have here it's a 70%, and then we have government clients, and we have then BPO, IT, and geographically we have like 32% comes from India, and 35% of the revenue of the company comes from Middle East uh, and Africa. Uh, and 21% comes from USA, and 12% come from Asia Pacific area, except India. So this is the great overview that you can read. So after the overview, we have to read companies like annual report. So if you go to the annual report, so this is the 2024 annual report of the company. And you don't have to read the whole annual report, you have to read certain part of it. For example, it's like director and managing director's message, CEO's message, it's an important thing. And we'll have some numbers in between that you have to read. And the most important part is the management discussion and analysis. You must read this part. You can't skip this part. So let's just hover. Okay, so yeah, you can see here all the geographics in which the Newgen operates. So it's a chairman and messaging directors. You can read this, you will get a good insight about the company. Okay, and after that, you'll see how much company is investing in R&D, in marketing, and how much of the company's revenue coming from annuity, how much company's revenue coming from the softwares and all. So you will get all the information of the company on this. And this is the services that company gives. First is ECM. It's a um, contextual content services, and second one is low code processes BPM, and other one is omni-channel customer engagement. Um, so this the middle one is the biggest, has the biggest market that we'll see in the management discussion. Let's go in management discussion. Here we are. So you'll find the information about the industry and the industry growth in this. Yeah, for example, we have the total worldwide IT spending forecast here. And let's see, where is our market? Yeah, so you can have the forecast here. For example, business process automation market is around $2.9 billion in 2023. And after that, we have hyper automation market. It's a low code market basically, which was around $38 billion in 2022. Then we have content management services, which will be around $9.4 billion. So like roughly you can say that the company operates in an industry which is around 60 to $80 billion market. A company's revenue, if you can see the company's revenue in 2024 or the last like TTM, you can see the company's revenue is, let's see, consolidated. Yeah, so company's revenue is around 1400 crore. It's not a big amount, but it's still, it's if you just convert this in dollar, you will get around 16 one around 160 $170 million, which is pretty less, and according to the whole market. So here you will see the consolidated financials of the companies here, and all the commentary of the business also on each part. For example, on profit and margins here, and you'll get a lot of things here. So you have to read these. And the after that, you can start with con calls. So conference calls as the best part to know about the company's day-to-day working and what are the challenges the company is facing right now and all. So you have to read this, at least you have to read for last 2 3 years to get the good idea about the business. Okay, so I have already read all of the like con calls and last 5 years annual report, and I have figured out few things about the business. Let's see those things. Okay, for example, in last quarter, I have noticed that management pointed out that the company can grow 20% continuously for a longer period of time, like in revenue term. That means if I take the 20% revenue growth, that would be our around like close to base case. Okay, and the margin will be higher in the 2025 financial year. Okay, means this financial year our margins will be higher due to some reasons. Okay, and the third thing that I came across is the company's revenue goal. So company has a revenue goal of $500 million, like in like in next 3 to 4 years. Okay, so company is targeting this, so we can model our revenue model according to this. For example, this can be our the like optimistic case in which company will achieve what the target is. Okay, then we have different things. For example, like I don't want to go into technicality of the business. That's why I'm just showing you how you can forecast the revenue growth and the margins. For example, the company uh, has said that the margin will be higher for FY 2025. So you can see that, and and you can also notice some trends, and then you can work on those trends in your financial model. Okay, so I have noted down all of the things here, and okay, so this was that. Okay, so after reading all of the things, you would have the basic idea about the revenue growth, about the about the EBITDA margins. Okay, so you will figure out those two things after reading. ठीक है, after reading con calls and reports and some research reports, you will figure out that. And for the reinvestment part, you can connect revenue. You can connect the reinvestment rates with the revenue growth rate. Okay, you can take percentage of revenue in your reinvestment. Okay, for WACC and WACC, you have to calculate that. Okay, there is a method for that. You have to calculate that. For perpetual growth rate, we'll see that. Okay, so let's now jump into the model. Okay, so first you have to gather all the data. So for the sake of simplicity, I have imported data from the screener itself. Okay, you can copy paste that, or you can download that as well. But remember one thing, you have to check your screener data with the company's annual report. Okay, so if you just write consolidated, you'll find the yeah you'll find the balance sheet, consolidated balance sheet, and the profit and loss and cash flow statement. Okay, you have to check these numbers with the company's annual reports um, financials. Okay, so after importing the data, you can start building your three statements. Okay, so first you will get these data from the screener. After that you have to forecast that. So I have forecasted that. Okay, so after you have forecasted that, then you have to link all the statements. For example, your net earning, the net profit that you will earn, should be connected to the balance sheet and the cash flow statement. For example, in balance sheet you have to show your profit in your reserves, so in your reserves, and in cash flow statements your profit before tax will appear here, profit from operations. Okay, and just like that your dividend also like will be connected with balance sheet and cash flow. Okay, so that your balance sheet can be matched. Okay, so our balance sheet is correct. Okay, so on the depreciation you can connect depreciation with your revenue growth, and after that you have to connect your depreciation here in the accumulated depreciation, and in the cash flow statement you have to add your depreciation here, because depreciation is a non-cash item. So you have to put depreciation here so that your balance sheet can be matched. Or okay, so this is the thing, and after that you'll do all the things and your balance sheet will definitely match. Okay, so after doing that you can build a revenue model before the three statement or after the three statements. It won't matter, because you just have to link your revenue part from the revenue model. That's it. So it won't hurt your like model, it won't disturb your model. Okay, so for the revenue part, I have tried to do some case analysis, like sensitive, you can say that, like case. Yeah, for example, I have taken three cases for this. First is conservative case, in which the company won't be able to meet the target, the half a million revenue target. Okay, so that's conservative. For example, if I just take one here. Okay, I have to increase the size. Yeah, let's say one. Then you will see the total revenue. Let me just freeze this. Let's just freeze this. Okay, so you will see that the company after 3 4 years, let's say this one, this would be around like 3000 crore, 3400 crore, let's say. Okay, and we are targeting, let's say, around 4500. Okay, so that wouldn't meet. And if I just say 222, then it would be close to 4000. Okay, which is around 80 to 90% of our target. And for the optimistic part, like for the optimistic case, you will see that our target has been like has been met. Okay, so this is the model. So let's just make it base case. Okay. The one thing is like I have forecasted the revenue of the company according to the geography of the business. For example, I have taken growth rate according to the uh, geographical area of the business, and I have given the lowest growth in the US part, because US is the most competitive market. And you've seen, after reading the con calls of the company, you will realize that company is companies is struggling in the US market because of like low code market is very crowded in USA, and the companies constantly doing stuff to increase the sales in the USA market. And I'm pretty like conservative on those things. For example, companies recently started targeting banks in USA, like USA, which has around more than $20 billion of assets. So yeah, they are doing things, but I'm not pretty optimistic on USA part. And other to market like Middle East and African market, it's fine. And Pacific is also good, so I have given the decent growth rate in those part. And you have to see this, the APAC market is a very like contributes only 12% of the revenue in the overall revenue mix of the company. So it's a pretty small market for the company. That's why you can grow that market in high growth. Like you can give high growth to this market, whereas to if you see the Indian market is pretty high for the company, and USA market also consists like 21 or the and the Indian market is 32%, which is huge for the business. It consists more than 50% of the business. Okay, so that's the part of revenue. And after doing that, you can add all the revenue and you will get the total revenue of the company that you can connect here at here. Okay, so after doing all of these, then you have to calculate the WACC of the company. So there are several ways to calculate the WACC. There are three parts to calculate WACC. The first one is beta, which will give you the which is the estimation of the riskiness of the company according to the market. Okay, and the second one is risk-free rate and equity risk premium. Those two parts you have to take the help of Ashwath Damodar's PPTs or numbers, so you can fetch those details. So what I have done, I have calculated the average beta of the industry, and after that I have calculated the unlevered beta of the company. So like what most of the people do for the beta part is they just take the regression beta, like this beta, and they just take the monthly 5 years beta from Yahoo, or they just do the like regression on Excel sheet, which is not the right thing to do, because regression beta is the historical beta that you use, but DCF valuation is about the future forecasting. So we cannot depend solely on the past data. Okay, it should be forward looking basically. Okay, so here what we are doing, we are taking the average beta of the industry so that we can like forecast the data more realistically. Okay, it's a pretty complicated part, so I just don't want to go into detail of this. Yeah, if you want to know about this, like how to calculate beta like this, it's called bottom up beta. So you can let me know in the comment section. I'll make a detailed video on how to calculate the bottom up beta so that you can estimate your WACC correctly. Okay, after that I have we got around 8.8% of our WACC, weighted average cost of capital. This is the discount rate. Okay, so here's come the DCF model. What we have taken in this, we have taken the EBIT and we have minus the taxes, and we have add the depreciation expenses, because depreciation is the non-cash expense, so we have to add back those. And capex and working capital, this is our reinvestment that we are doing. Okay, so WACC, capital expenditure, I have taken that from the cash flow statement, and it's a 2% of our revenue. And working capital I have taken from the working capital schedule that we have made. Okay, and after that, this is the free cash flow that we'll get, free cash flow to farm. Okay, and so free cash flow to farm, like if you are taking the EBIT, which also includes the interest in the earning. So that means we have interest we also owe to the debt holder of the company. So that's why we call this free cash flow to farm. If we'll take the interest part out from this, then we'll have the free cash flow to equity. So we'll have FCFE here if we like take the interest part out from this. Okay, so we have free cash flow here, and we have our WACC here. We can calculate the cumulative discount factor here by just dividing it from from this. After that, we'll have our present value of free cash flow by just multiplying the cumulative discount factor with the free cash flow to farm. Let me just freeze it. Okay, we'll have that. So this is our free cash flow to farm. But what would happen after the 2034? The business will continue now. So that's why we have to calculate the terminal value. So for terminal value, we have to take some assumptions, and uh, we have to estimate the terminal growth rate. Let's see. Yeah, so this is the terminal growth rate that we have estimated for our business. So terminal growth rate, so most of the, like say 50% or more than 50% of the DCF valuation comes from the terminal value. So you have to be very careful while calculating this. So terminal growth should be less than the long-term GDP growth rate of the country in which your company operates. Although I have taken 6%, and it's still it's very optimistic, because our country will not going to grow at a 6% rate for the longer term, because it's not sustainable. As country grows, the rate of growth also slows down. For example, in advanced economies, we have 2 to 3% GDP growth rate, real GDP growth rate. And for example, let's say after 60 or 70 year, if our country become a advanced economy, then our growth rate would be significantly lower compared to today's growth rate. Right now we have around 6 to 7% GDP growth rate, long-term GDP growth rate. So I've taken 6%, which is optimistic for me, but anything between 4 to 6 would work in this model. Okay, and there are some arguments about the terminal growth rate, that terminal growth rate should be kept on the risk-free rate. And our risk-free rate is around let's say 4.4. Okay, so anything between 4.4 and 6% would work. Okay, so that's the terminal value that we have calculated, and after that we have to adjust it for the present value. and we'll get the present value of our terminal value, and we have our, if we just add our free cash flow present value, we'll get our total value of free cash flow to farm. After that, if we just add both of these things, we'll get the enterprise value, and then we have to add our cash from the balance sheet, and we have to minus the debt part so that we can calculate the equity part of the uh, business. And after deducting the debt, so debt is very negligible in this company, although in IT businesses that part always is negligible. For example, if we just look the uh, comparables that we have around 15 companies, and you can see the debt to equity ratio is very low. For example, we have like 0% and 0.1. We don't have even one, or we have only 2 3 companies which has more than 0.5 um, debt to equity ratio. Okay, so that's an industry trend. So after deducting the total debt, we'll have our equity value, and if you just divide this equity value from the outstanding share that the company has, you will get the value per share. It's the value per share, and right now the company's stock is 134, if I'm not wrong. Let's see. Yeah, yeah, 1034. If you just write 1034, you'll see that the company is overvalued by 83%. Okay, and so that's all. That was our model, and you can do different things. Uh, you can do sensitivity test here by applying WACC and other values, and you can do some, you can play here also. For example, if I am optimistic about the Indian growth story, you can give 3 here. You'll see that the value has changed. And if you are not very optimistic on the USA part, you can give this 1. And then I am optimistic on Middle East part and European part, and Asian part I'm opportunity like optimistic about that, so you will get this value. Okay, so you can do some input output changes and see what value you will get. That's called sensitivity test. You will make different models also, that we'll talk about in some other video. So that was it, guys. This is the model. If you have any question, this is the first video I've recorded that long. So if you have any question about how to do DCF valuation, or how to make 3 statement model, just let me know. I'll try to make another video for that. Thank you so much.